Hey, what's up guys, it's Jonathan here, back with another public stock portfolio update. We're going to do a quick recap of some of the moves we made in the account, as well as a quick overview of how the account's doing. And I'll talk about a couple of things I'm going to watch out for next week. So with all that said, let's get right into it. And as always, if this video provides you any value, please consider hitting the like button. It greatly helps out the channel, helps push this video out to as many people as possible. So let's get right into it. So as usual, we did deposit our $10 into the account. We did make one buy order, but there were some buy orders I did make on my private accounts that I did want to make on this account as well. So I'll just talk about them here. So on Wednesday, the first thing we did is that we sold off our position in SoFi. And I sold off $3.56 of SoFi at $9.57 a share. The main reason why I sold this off is almost some of the reason why I've sold off some of my other fintech positions. With SoFi, about 77% of the revenue comes from lending. And in a rising interest rate market, people are a lot less likely to refinance their loan. And given the fact that the treasury is almost at 2018 highs, that means that for the past 4 years, people have been able to refinance at a lower rate compared to the rates that they could get now. And because SoFi is an unprofitable company and a lot of their stock price is dependent on their ability to grow, and my belief that I don't think their lending space won't grow as fast as what the market initially expected, I don't really think that this is a company I want to be in right now. It is also fair to mention that they will probably see an increase in interest income, given that when rates go up, also the rates of variable rate loans will also go up as well. But I don't think that'll be enough to offset the reduced demand in lending. Something else that's good to mention as well is that SoFi does have a brokerage portion of its services. And even though it only makes up about 2 or 3% of total revenue, it still is something to watch out for. We have started to see numbers of transactions start to decline. They have the same business model like Robinhood, where they do payment for order flow. So as we start to see transactions decline, we will most likely see that revenue decline as well. And then even on top of that as well, their valuation is pretty crazy. So their valuation at the moment is currently 450 times 2024 earnings, which when you compare that to a very similar company like Square's valuation is 230 times 2024 earnings. Granted, SoFi is supposed to grow twice as fast as Square will. In my opinion, I still feel like the valuation's a little too high right now, even though it is at almost all-time lows. So I'm not necessarily throwing my towel in on this position, but I think that there may be a chance that we may be able to pick up the stock for less later on. Possibly, I believe that once we start to see a U-turn on the 10-year treasury and the rate increases, I think that at that point, that would be a really good time to pick up SoFi. So like I said, there was a couple positions that I did want to buy in the public account that I forgot. So for all of you guys who are on public, I'm sorry. You guys usually know first when I do make any buy or sell decisions. But unfortunately this week, it was a really crazy week and I just forgot to do it. And then if you aren't on public, you should consider joining. We do have a link in the description down below where you can see me make all my trades live. So if you're interested, check it out. So I'll call these the honorable mentions. The first one was Disney. I probably would have bought about $4 worth of Disney, around $140. And I remember, I think I made that purchase on Wednesday morning. So, like I said, I did make those purchases in my private accounts. I did some research Tuesday night looking at the prices of some of the companies that I did want to buy. Remember, in my last market update video, I did make a big emphasis about buying companies that are not only profitable, but do have some growth behind them as well. Now, Disney isn't the biggest growth monster out there, but they are one of the few companies that are profitable that I like, that are still inside a price range where I think that you could still buy. So I decided to pull the trigger on that. It is good to mention that they still do have some debt related to the pandemic, I believe on their cruise line business. But those debts are at very low interest rates. I think right now they're currently at like 2 to 3%. So I'm not too worried about that. They also are a very huge company, so I don't think that they're gonna have problems paying back that debt in the long term. Another purchase I made, and this was one that I kind of wish I didn't make, so it was kind of a good thing I didn't do on the public account. But I did buy some trade desk Friday morning, and in the public account I would have probably bought about $2 worth of trade desk at 65 bucks. I do want to add more to this position. I think right now it's at like $65, and that's a little too high. I'm probably gonna wait for it to get like sub 60. Start adding on more to that position. That is another move that we did make. So let's go into my iPad and let's see how the portfolio did this week. So currently the portfolio sits at $268.43. And for the week, it's up 3.5% or about $9. And for the month, it's up 11.5% or about $28. And all time, we are still down about 8%. Just a quick explanation on why the graph is moving up, even though the position is down 8%. That mostly has to do with the fact that this graph also includes the deposits we make into the account. So because we keep making consistent deposits, the value keeps going up, even though the value of the assets themselves are down from when we bought them, which to me I think is a little weird. I know most brokerages usually don't do that, but this one does. So I don't know. I kind of feel like it's somewhat deceitful because you see a red graph, but it's still moving up. So I don't know. Public, if you're watching this, get your shit together. Anyways, we have buying power of about $44. Still some money on the sideline. Even though we are starting to see the market move up, I still think there's a lot of possible negative catalysts in the market moving forward. So I'm not ready to go all in just yet. I still want to have some cash left over. That's why we're still holding on to some cash. So the first position we have here is Tesla. Our Tesla position is currently up 20.5%. It makes up about 25% of the portfolio. Like I said, Tesla is around $10.10 a share. In my opinion, I'm not the biggest fan of paying for Tesla at $1,000 right now. I think that for me, if I didn't own any Tesla shares, I'd probably still buy some. But I don't really know given the kind of position I already have in Tesla, I probably wouldn't add more to this. So I already do have quite a bit of it, so I'm not really in a rush to buy more. Next position we have here is Enphase. Our Enphase position is currently up 20%. I think Enphase is like almost at $200 to be honest. Yeah, $193. Enphase I think is still going to be doing good as long as energy costs stay high. I think it'll mostly depend on the war in Ukraine ending. So until then, we probably will still see these high energy prices, and in turn, we'll see Enphase kicking butt. It currently makes up about 17% of our portfolio. Our next position here is NVIDIA. Our NVIDIA position is currently up 16% and makes up about 13% of the portfolio. NVIDIA did drop down to like 206 at some point. And I remember, I think I did buy at that point. Like as always, we all wish we could buy more when it was down. Probably once the stock gets below like 225, it's a little extreme. I think that makes a good buying opportunity. I believe now it's like almost 300. Let's see. 276. Yeah, it's all right. I mean, I don't know. I'm not excited to buy at that price. I think if it was sub 230, I'd be a lot more excited to buy. And then if it was sub 200, it's like, not financial advice, but for me, I'll be like, yo, time to take out margin and buy this thing. Our next position here is Google. Our Google position is currently down 1%. It makes up 7% of the portfolio. Google, is kind of one of those flight to safety stocks. Has been pretty volatile recently with the indexes. Google does make up a good chunk of a lot of these indexes, so it makes sense why we are seeing some volatility in Google. Obviously, a really great long-term buy. Next position here is Etsy. Our Etsy position is currently down 30% and makes up almost 7% of the portfolio. So one of the things we have to understand about the stock market is that it's a forward-looking mechanism. It's constantly looking anywhere from 6 to 18 months out. And that outlook is what really affects the prices of certain companies. So for Etsy, the reason why Etsy is going through so much pain is that right now what we're starting to notice is that the consumer is spending less money at buying stuff at home. So think Amazon, think Etsy, think eBay, think like Overstock, Wayfair. That's kind of the reason why we've seen those stocks hurt so much. So the thing with Etsy is that there's a lot of fear that their growth isn't going to be as good as it was once expected to be. But still, at the end of the day, I still think Etsy is a good company. I just think that right now, the at-home consumer is not very strong. And that's some of the reasons why we're seeing pain. Like in some of the companies I said, you can even throw Peloton into that boat to some degree. Next position we have here is trade desk. Our trade desk position is currently down 3%, makes up of 4 1/3 of the portfolio. Trade desk, like I said, I think it's good buy 60-ish or below. I believe our cost base is around $68 and it's like at 65 or something like that, so we are down a little bit. But yeah, trade desk I think is going to be a really good play. So the next position we have here is Matterport, and our Matterport position is currently down 51%. It makes up about 1.5% of the portfolio. With Matterport, it's almost kind of like what I said with Cloudflare. They also are going through a situation where they're transitioning their business model away from being a hardware and software business model to just being a solely software business model. And that mostly has to do with the fact that almost every iPhone can take Matterport scans now. So until this adjustment starts to get priced in a little bit better, the valuation on this company will continue to hurt. But in the long term, I think that it will be a better business model for them as it'll have less expenses tied to it. Almost like any other software company would have. The next position we have here is Palantir. I won't give the spiel again because I did give it with Cloudflare. So if you want to know what's going on with Palantir, listen to what I said about Cloudflare. It currently makes up 1% of our portfolio and it's down about 43%. So for next week, the big thing I'm really looking for is any inflation indicators. I believe on next Friday, we're supposed to get the jobs report. The big thing to look out for is really wage growth. We really want to make sure that that wage growth isn't getting out of hand. Mostly just because that is a really good sign of a possible wage price spiral. And that will determine if this inflation is more persistent or if it's just still transitory. We also have the retail inventory report, which I believe is supposed to be this Monday. So the day this video comes out, basically. Just what we really want to look for is how if there's inventory growth or there's inventory decline. If there's inventory decline, that means that people are still going out and spending, which means that inflation is probably going to get worse. If we start to see inventory start to grow, then that means that we may start to see more reduced inflation. Also on Wednesday, we're supposed to get the GDP report for the first quarter of this year and expected to come in 7% year over year. If we see higher GDP than expected, then most likely that will be a sign that inflation is more persistent. Whereas if we see GDP that is less than expected, then that'll most likely be a sign of less inflation. So that's basically all I got for you guys this week. Thank you so much for watching. If this video provided you value, please consider hitting the subscribe button and notification bell. It'll greatly help out the channel, help push this video out to as many people as possible. Also, you'll get notified anytime I do post a new video. So we're trying to get back to posting twice a week, so please help us out there and consider hitting that subscribe button. Also, let me know what you guys think about the markets and what's going on in the stock market right now. Let me know your thoughts in the comment section down below. I would love to hear from you guys. Also, check me out on all my social medias. I try to post there